Do it. StreamYard. Oh, there we go. Took it a second. And we're live. Live in the Book of Faces. LinkedIn, YouTube, Twitter. Bring it down. Can we meet under better circumstances next week, please? That'd be great. Yeah. Yep. The looming government shutdown. Well, if we just go back here, let me pull some. And I'll keep these rates up, and I'll try to flash them as much as possible throughout this process. It seems to be kind of all over the place. People are getting crazy quotes. And of course, I'm using good credit scores for these, conforming balance. So if you have a condo or a high balance, VA or whatever, maybe a little bit different. But this is in general basic rates for these different programs. And we lost another 44 basis points today. That's an 1/8.5, 3/16 approximately of a percent, or we could just say close to 3/10. And, we've seen the same pattern before. So let's look at this for quick. So right here, this is what happened the last time we had a debt ceiling debacle. Remember that? Yeah. Bonds don't like the uncertainty that the government might shut down and not pay its debts. Okay. Bonds don't like that. Bond market, not a fan of this. Not a fan of this whatsoever. I don't have any really good drawing tools on here. I don't think, actually. Maybe I should investigate it further. But you've got a channel coming down here. So there's a humongous daily downward channel that has to, at some point, it looks like it's liquidating right now. At some point, it's got to break to the upside. When? Your guess is as good as mine. It could be next year. I don't know. But we've now reached a point where bond prices are actually lower than they were when rates were at their peak. So we're going to go through a few different stories on that. Look at this. But long story short, in the coming days, so until the debt situation gets figured out, okay, potential for Moody's, other ratings agencies to downgrade U.S. debt. That does a number on the bond market. That does a real number on the bond market. You can see it's already doing a number, just the thought of it, just leading into the days before. 10-year Treasury yield reaches level not seen in more than 15 years. Now, when you see headlines like this, always note that typically when you're seeing something where it's saying, hey, this is the highest we've seen this in a really long time, or this is the lowest we've seen this in a really long time, those usually mean that the move is over. So don't think that to mean that, oh, it's just getting started. That usually means the move is over. We've actually gone so far, capitulated so far, that we haven't been here in 10 years. That means if the move isn't over, it's mostly over. Mostly over. Like, I wouldn't short bonds here. Would you short that chart? Would you sell your bonds there? Does that look like a good time to sell your bonds? No. Terrible. Terrible time to sell. Should be huge buyers coming in here. They're not. They are not. Which means either they believe there's a better place to put their money, or they believe there's more downside. Either way, it doesn't help us. It does not help us with rates. Here, let me put those back up. So on the VA side, high sixes, FHA high sixes, conventional mid sevens, conventional high balance close to 8%. However, we can do that high balance ARM is actually under 7% right now. Jumbos close to 8% on the fixed and close to 7% on the ARM, the 5-year ARM. These are all based on 780 credit and just sort of random loan amounts. But that gives you an idea of where things are. Pretty close. Not too bad. I mean, if you see on the average, the VA and FHA are way higher than me. But usually I'm 1/4 to 3/8% better anyway. So that actually jives with the norm. 5/1 ARM on that jumbo right at 7. We're pretty much right there. A little bit below that. And 30-year fixed on the jumbo. We're all a little on the high side, close to 8% there. Now, when we look at, what should we expect in the coming days, here's what we have. We have a series of days that are probably going to be terrible, leading up to what will most likely be, they'll figure it out, right? They do every time. And every time the financial markets get super concerned, everyone's worried, oh, this is the time. They're too far apart. They're not going to figure it out this time. If the politicians can't figure out how to fund the government collectively, it's bad for all of them. That's one thing that both sides understand. If they don't get it done, it's bad for everybody. Nobody wins. Nobody can go and say, look, we won. The VA is not funded anymore. We won. Active duty service members aren't getting paychecks. We won. No one is going to be able to take that as a win. That's not a W for anybody. So they're going to meet in the middle somewhere, somehow. Maybe somebody will get a little bit better of the agreement or whatever, but they will most likely, 99.99999% chance, it's been 100% historically, fund the government. However, it's the concern. This is where sentiment can be so powerful. The concern, it might not. They might not. It's possible. 0.00001%. It's possible they won't fund the government. What would happen if they don't and the government misses any payments on its debts, aka the bond market? Then we'd have serious problems. We've already seen rating agencies, take us out of that AAA rating down to AA+, which is still a great rating. That's happened a couple times. That could be worse. Maybe we go AA- or something like that. And so, there's things there that would cause really big problems. They would probably be short-lived, but they would be really big problems on paper in the short term. And this is going to be over the course of the rest of this week, basically. And potentially heading into next week. You never know what could happen. They could kick the can for a week. They've done that before. Hey, let's figure out how we can punt this for a week so we have another week to figure it out, because we're not getting to an agreement here, so let's agree to just fund one more week. They could do that too. But the longer it drags out, the worse it's going to be, because there's no confidence. We need confidence in the bond market for investors to step in and start buying this thing so we can get higher prices and get lower rates. We just don't have it right now. So this is the biggest thing right now. Ratings agencies have their, what do you call those things? Not a telescope, microscopes out, and they're watching very closely. They want to see what happens. They might rug pull us. Fannie Mae's chief economist. Now I'm going to put this one. I'll put all these links in the description on the YouTube channel so you can read it. I would highly recommend reading this. Fannie Mae's chief economist on housing market outlook. It's basically just like an interview, and they provide the transcript here. Here's the things that I think that are most important. Doug Duncan is the guy. We don't have the Fed dropping rates until Q2 of next year, and we have a mild recession that starts in that quarter. So he's predicting a mild recession that will begin next year. They believe also that's when the Fed will start dropping rates. Someone that we'll go nameless, has been telling you that exact same thing. What's up, Slim? You're welcome. So, and by the way, we are live, so you can drop comments. You can say hi, ask questions, give us your 2 cents. It's all good. Mild recession. The reason that forwards are suggesting a 50-50 chance of another increase is that growth has been stronger than anticipated. We actually think that's going to slow. I think that is kind of like a final burst of activity. So they're predicting a slowing of the economy. Now, this is exactly what the Fed has been trying to do. By the way, no matter how they sugarcoat it, no matter how they word it, they've been trying to slow the economy down. It's not a pretty thing. You've heard the term soft landing. It's sort of like you're in the air in an airplane, and the Fed is in there, and they're going, you know what? Cut the engine. That's basically what they're trying to do. I mean, that's what they've done by raising rates. They're just taking all the wind out of the sails. But there's still a chance you could softly land the plane. Yeah? You have a good enough pilot? Anyone who's been through pilot school knows that those crash landing drills are for real. And my instructor had me so scared. I thought we were seriously going to land the plane in a friggin' field. We were so low, and he had me with the controls, and I was like, oh shit, I actually have to land this. And then he finally grabbed it and pulled it up. It's like, good Lord. But that is essentially what's going on. They're trying to avoid a crash landing, but they know that we're coming to the ground because the Fed is bringing us there. They took the gas out. They cut the engine. That's what these rate increases have been about. So Doug Duncan thinks second quarter next year. And then he says, we don't know what third quarter growth has. Our expectation, an annual rate is north of 3%. there's another quarter like that, oil prices push to 100, you can get another quarter point move by the Fed, especially if you don't see a substantial change in employment. So he's thinking there could be some cuts early next year, and that would be something that could turn sentiment. So when I've been telling people, like, price-wise, good time to buy if you want to invest in real estate, second half of this year, maybe even early next year is probably going to be the best time, is because that sentiment is terrible right now. Sentiment's terrible. People aren't excited about buying homes right now. They're not excited about investing in real estate as a whole. A lot of that luster has been lost, and that's a sentiment issue. If you sat someone down in a serious conversation with their financial advisor or something like that, and you ask them, do you think it's a good idea to invest in real estate, or do you think it's a good idea to rent? No one's going to say, I think it's a good idea to rent long term. Or, only people who want to be different would say something like that. So it's not that the overall concept and the overall principles have changed. It's really just a matter of sentiment. It doesn't feel right now. I don't like it. I don't like that rate. I don't like that payment. I don't like it. It doesn't feel right. Emotionally, I don't like it. But that doesn't mean that the concept behind it or the validity behind it has changed. That's why I've been trying to say this might be the time to get the best price, because when that sentiment turns and all those people who push this idea to the right step in, it's liable to send prices higher, and it could be a little bit crazy. Newly built homes reversed course, dropped 9% in August. Why? Well, this is why. Where does August start? Right here. What's happened in August? Rates have just gone straight up, basically. We had that one little run. Remember I told you not to get too excited about that one? Same thing that's played out over and over and over here. But basically, since the beginning of August, rates have gone up steadily. That hurts home builders the most because they have the most expensive inventory. Always. They always have the most expensive inventory. That's what you're getting when you're buying a brand new home. You're buying the most expensive home per square foot that you could. Now, I'm not too scared by this because new homes, the most expensive inventory, what's happening with that doesn't sway me as much. I'm looking at inventory numbers overall and sentiment to be the two main things, because we have supply and demand, right? So I want to know those two things. Sentiment is sort of my read on supply or on demand. And then supply, of course, we just look at inventory. This also has a lot of people scared. Neil Kashkari said 40% chance, meaningfully higher interest rates. He's talking about raising not just a quarter, but potentially more. He thinks that there's a high pressure equilibrium situation in which inflation stays elevated and requires potentially meaningfully higher interest rates. So obviously at this point, we need to see these inflation reports coming in a little bit lighter, a little bit colder, coming in a little hot. We need to see that recede a little bit, and that'll send us in the direction of cutting rates. But I don't think the Fed can cut rates if we're above 2%. So I think they're going to really need to see us get below that. And the last thing, if you remember what Jerome Powell said in his last speech, stubborn housing market just keeps going up. Like he was saying, like, we're trying to knock it down. And it just keeps going up, stupid thing. And so that's been on their list. That is high up there. The things that's keeping that total inflation figure above 2%, housing is definitely a part of that. Definitely. And they're trying to attack it. And it is working. Mortgage demand shrinks. Interest rates at the highest level in nearly 23 years. So average interest rates take over. This was just today. Higher than they were in October of 2 years ago. When, is that right? Is that October of 2 years ago? When did we hit that low? No, it was October of 22. Sorry. October of 22, right? Yeah, October of 22. This is 23. So about a year ago, that was when we had the highs in rates, lows and bonds right here, right? Recovered, bounced off that, sort of a dead cat bounce. So look at it. Just not what you want to see. Not what you want to see, but that's what we've got. That's where we're at. This rounding here is bad. It's not good. Not good from a technical standpoint at all. And I can tell you firsthand that mortgage demand has definitely shrunk. Not that there isn't people who want to buy homes. There for sure is. But there's a lot of people who are sort of postponing the idea. And you know what? Let's rent to you another year. Or you know what? This time, the payments are too high right now. This is why the 2-1 buy down, the 3-2-1 buy down are so huge at the moment. So huge. This is a time where a lot of buyers are choosing not to buy. And if you want to buy and get the best price on something, typically you want to buy when other people don't want to buy. Like if you look at recent example, let's look at when I bought Tesla down near $100, $105. And I was calling, and I don't talk about stocks all the time. I'm talking about a couple stocks that I like and that I invest in. No one wanted it then. No one wanted it. No one wanted Tesla $105. Everyone was dumping it. That was the best time to buy it. So typically, the best time to buy is going to be when the majority of people don't want to buy, are too scared to buy, or there's too much uncertainty out there. And that is kind of what the position that we're in right now from a real estate standpoint. So this, of course, another one talked about earlier. This is a big deal, right? The 10 years, what everyone's looking at. And now this has hit a level not seen in 15 years. But mortgage demand, we're talking about 23 years. This is even worse. Why are mortgage bonds getting hit even harder? Why is the relentless selling taking place? Well, you have the Fed dumping bonds, and you also have these seized bank assets from Silicon Valley Bank. Can't remember the name of the other one that was seized. There was like $13 billion worth of mortgage-backed securities on the books. And the government's got enough of that. So they're unloading all this stuff. It's just a perfect storm. You add that to what's going on with the government shutdown, and it's just a perfect storm, a perfect shit storm, to be honest with you, for interest rates. So interest rates in the short term, maybe this week for sure, possibly next week, we'll see if they kick the can or what happens with the shutdown. If the government does shut down, that would cause really, really big problems in the bond market and in the interest rate world. Probably short-lived, but it would be bad. It's probably going to be bad anyway. It would be even worse than that if that takes place. So next few days, expect higher rates. Just expect that, plan on that. Hopefully, that'll be the last wind of it. Hopefully, that'll be the final capitulation. It's going to be really ugly. It's going to be really ugly if it is. If it's not, if we just kind of drift lower, that's not the capitulation. It's not the end. So we're going to be paying very close attention to that. Let's see what's going on with that. And at the end of the day, I want to make sure and see where my rates are at today. Let's see what we have for jobless claims tomorrow. Okay. This is an important thing that the Fed is looking at as well. So these things are going to move the markets. We're also going to get pending home sales and a potential GDP revision. So market's going to get some interesting data tomorrow. You know what? Did we want to pull this up? Let's do it. Let's go to, we're just going to look at the S&P here quick. We'll do the S&P and we'll do Bitcoin. S&P. And I got to tell you guys, I've nailed this. I mean, right across, just all the way. We nailed the top on this. I told you where the bounce was going to take place, and also that I hated it up here. Absolutely hated it here. I was expecting much lower prices, and that's what we've got. Now we're down to the very last possible rally point. Now, there was a rally late in the day today. And it looked like there was no news or anything, so it kind of made it look like somebody knows something. You know, a lot of times you get that late day rally, and somebody knows something that's going to drop tomorrow. So maybe there's numbers coming in tomorrow. They're going to be really good, or, you know, I don't know. But we had to get a late day rally today off seemingly nothing. And so when you see that, it's like, hey, maybe we will get a pop. You know, we could pop back up into this former support right here. See, this was support before. It's not anymore. We could get a pop back up into that, and then that would give us the move that we need to take down, the momentum that we would need to then go down and break this support. But we are delivering from these bullish fair value gaps over here. So that could be it too. But price going higher at the end of the day today. And that typically is strong. We'll see. Never know. Anything can happen. But very, very, very weak look. Very weak look in the stock market, as I've been telling you for several weeks now. What was the other one going to do? We're going to do Bitcoin. Bitcoin, incredibly boring price action, but has done what? Has held the support I gave you. When did we give you the support? A long time. Oh, when it crashed. We did the flash crash. That was on August 17th. Showed you where the support was, and it's been holding. And that's pretty wild to me. But, this ETF situation is for real. It's very likely that we're going to see ETF approval this year. It could be early next year too. And everybody's getting in on it. I mean, everybody's getting on Templeton, BlackRock, Fidelity, Grayscale. Everybody's wanting a piece of it. Now, why is that important? Because if you're going to issue an ETF, you have to hold the underlying asset. So in other words, when people buy your Bitcoin ETF, you have to turn around and go buy Bitcoin so that you have the Bitcoin to have the net asset value that represents the ETF. And so that's one thing that we haven't seen at all in the crypto market on the buy side. And so introducing that would then now create sort of a constant flow of buyers into the Bitcoin marketplace, potentially at large scale. So we'll see. But the support is holding. Support is held from the flash crash. We'll see if there's another drop. I still kind of think we're going to see lower prices here, but hope I'm wrong. And ultimately, this is really the big deal right now. This is really where it's at. What we've got to figure out is, when does this pain stop? When does the bond market finally capitulate and be done with the selling? That's going to tell us when rates turn around. Rates turning around is likely to turn sentiment around, and that is what is going to lead us into the next real estate bull market, likely Q2, Q3 next year. In the meantime, it might be tough out there. My friends in the industry, keep working hard, okay? It's going to be tough times. I'll be here if you need me. Have an awesome night. Take care.